Hello and welcome to the Irish Life podcast series called Embracing Investments. Here we talk with key people at Irish Life Investment Managers, or ILIM for short, who shared their expertise and insights on the main issues that impact on the value of people's pensions and investments. My name is David Haslam, and in this podcast I'm joined by my colleague Dara O'Dowd, who's ILIM's Head of Portfolio Solutions and is part of a wider team of experienced fund managers who are responsible for the investment strategies behind Irish Life's range of Impera or growth funds offered in your pension savings plan. We've all seen the huge impact that coronavirus has had across the world, and we understand how unsettling this environment can be. It's had a big financial impact, and no doubt many of you will be concerned about how it's affecting the money you're putting away for retirement or for your investment nest egg. Dara is here to update us on how the Impera or growth funds have been designed to weather events like the current crisis, and we'll also discuss some of the pitfalls to avoid when investment markets go through difficult periods like this. On that note, I might introduce my guest. Hi, Dara.
Hi, David.
Dara, let's start at the start. The main growth funds are investment portfolios. Can you briefly explain exactly what investment portfolios are?
Sure. Essentially, they're a collection or a portfolio of investments in different asset classes. So it could be a portfolio that invests in shares of a company, also called equities, bonds, property, cash, perhaps even alternative assets like infrastructure, for example. They're all different types of assets, and there are benefits to spreading your investment across many rather than just focusing on one type. And this is often described as not putting all of your eggs in the one basket.
Great, got it. So what's the objective of the Impera funds, or put simply, what are they trying to do that is different to other funds that members might have access to, such as indexed equity funds, for example?
The number one objective of the Impera funds is to deliver a smoother investment journey or experience for investors. By that I mean to reduce the impact of inevitable investment bumps on the road along the way. Stock markets can be volatile, and we typically hear news coverage when they're either very high or very low. We know from a lot of research that people are most influenced by these highs and by these lows, and people can often act on them, trying to time their investments, aiming to be in for the highs, but missing the lows. Unfortunately, this research consistently shows that it's nearly impossible to find the absolute best time to either buy or sell. In fact, most people end up worse by trying. Research in 2019 on the US stock market by Morningstar, a global investment research company, estimated that people trying to time investments lost out by about 2% per annum. And that really does add up over time. And when we think about some of the most famous and successful investors of all time, they simply, a lot of them, buy and hold. And I understand that might seem a difficult thing for people to do right now when markets have had big falls recently, but it really is the best approach to take in the long run. To help investors get the long-term benefits associated with staying invested, Impera uses investment strategies that aim to reduce the impact of short-term stock market highs and lows on performance. This helps deliver a smoother investment experience, which in turn reduces the temptation for investors to act. This is really important when faced with markets like we currently see.
Thanks, Dara. While that makes a lot of rational sense, we all know that it can be challenging for people to do the right thing at the right time. And I know I've certainly been tempted in the past to buy or sell when in hindsight, the smart thing to do was nothing. So how do you deliver a smoother return for investors over the longer term?
Well, there's two critical elements to it. The first is diversification, and the second is risk management. In relation to diversification, this is, as I mentioned, the idea of spreading your investments to help smooth the investment journey. The way it does that is by investing across a wide range of assets, investment strategies, geographies, and currencies. This ensures that the fund is not exposed to any one factor in particular that could materially impact performance. Indeed, there's parts of the diversification strategy that are specifically chosen because they may rise when others fall. In relation to risk management, we use specific strategies to reduce risk, equity risk in particular, within the growth and Impera funds. Example would be our low volatility investment strategy, which invests in less volatile equities. Another example would be our dynamic share to cash strategy, or DSC for short. And this aims to reduce the exposure that the growth and Impera funds have to the equity markets at times of prolonged stress. DSC applies to the global shares allocation in these funds. And because of current volatility, has actually moved recently 60% of that allocation to cash funds, similar to bank deposits. This has provided real protection. And we do have other risk management investment strategies to take account of other market environments to help us mind and take care of people's money as best we can. Members, I think, can learn more about these investment strategies by visiting the Impera app on your smartphone or by logging on to Pension Planet, or indeed by speaking to your financial advisor.
Okay, that sounds very reassuring. You've got all these ways to manage risk, but how does that impact on the way that the Impera funds will perform over time? Will it be better or worse than, say, traditional growth funds?
It's not necessarily either over time. The performance of two different portfolios may average out to be the same, but the manner in which they are achieved can be very different. One may experience extreme highs and lows, the other more steady, stable returns. The smoother and more stable returns are, the more likely an investor is to stay invested and do better in the long run. People don't like extremes or nasty surprises when it comes to investing. Indeed, investment strategies in the Impera funds were designed following member feedback that told us the smoother the journey, the better. When it comes to performance, it's also important for investors to know what to expect. This smoother investment journey enables us to calculate an expected future range of returns for the Impera funds that we are confident of delivering to, which shows for each fund what they're likely to deliver over given time horizons. These are not guaranteed returns, but they do help people to understand better what to expect. Since launch of the funds in 2015, they've managed to stay within these expected ranges of performance despite the many headwinds that we faced along the way, including the Greek and Eurozone crisis, Brexit, and now, of course, the coronavirus.
Finally, Dara, what would you say to members in either the Impera funds or the growth funds who've seen their fund values drop this year, given what's going on in stock markets?
Well, David, the first thing is to recognize that every member's circumstances are different. So a review with their financial advisor will help give them perspective in terms of their long-term financial goals. I know people are worried when they hear that stock markets have fallen, in some cases by over 20% since the start of the year. However, the investment strategies in the growth and Impera funds are much more widely diversified than the stock market, and also benefit from a range of investment risk management strategies. So, for example, the risk management investment strategies in the Impera Cautious Fund have meant that while the stock market is down, say, 20%, the fall in that fund has typically been closer to 12% over the same period. While any fall is obviously a concern for members in the very short term, it's important to remain invested to benefit from the recovery which will come in time.
Thanks, Dara. That's been a great insight into the Impera funds and the investment strategies behind them. And what really struck me about what you had to say is the simplicity and effectiveness of diversification and risk management, but also the expertise and experience that must be required to make them work as well as they have. It was also really interesting to understand the behavioral aspect that's involved, aimed at staying invested to benefit not just from the highs, but also recovering from the lows. Approaching retirement can be a time of uncertainty, making the behavioral piece relevant in the context of the lifestyle strategies, which I know most members avail of. These are strategies that reduce your exposure to higher risk funds by gradually switching to lower risk funds as retirement approaches. In simple terms, they remove some of the worry and doubt about what to do and when, as Irish Life will simply do it for you. And finally, I think it's very positive that since launch, the funds have stayed within the expected range of returns. To be able to say it's doing what it says on the tin is a very powerful message of comfort in times like this. That's all from me. Thank you for your time, and I hope you found this podcast useful. Before we go, we must read out the following consumer protection warnings that apply to the Impera and growth funds.
Warning: past performance is not a reliable guide to future performance. The value of your investment may go down as well as up. If you invest in this product, you may lose some or all of the money you invest. This fund may be affected by changes in the currency exchange rates. When you invest in this product, you will not have access to your money until you retire.
We hope you stay safe and well. Goodbye for now.
Irish Life Investment Managers manages funds for Irish Life Assurance. Irish Life Assurance plc is regulated by the Central Bank of Ireland. Irish Life Investment Managers Limited is regulated by the Central Bank of Ireland. Information is correct as of the 22nd of April 2020.